Good evening, everyone, and a very warm welcome to today's webinar on international tax planning, core issues, and practical strategies. Today's session brings together seasoned professionals and thought leaders to discuss the real-world cross-border tax, restructuring, and compliance challenges faced by India, US, IT, and ITES companies, particularly as they scale and mature. This webinar is organized by the Indo-American Chamber of Commerce in collaboration with its long-standing member, MCA Consulting Pvt. Limited. We are delighted to have such a relevant and experienced panel with us today. A little bit about MCA. MCA Consulting is a specialist advisory firm offering cross-border tax advisory, finance transformation, and a virtual CFO services, helping Indian and multinational companies align tax, operations, and governance to enable sustainable and compliant growth. Today's session will be co-moderated by Mr. Sachin Kumar BP and myself, Amrita. Sachin is a fellow member of the Institute of Chartered Accountants of India and an alumnus of the Indian Institute of Management, Bangalore. He is the Chief Strategic Partner at Manohar Chaudhary and Associates, or known as MCA, a chartered accountancy firm with 24 partners across 14 offices in India. He serves as an independent director on several domestic and international boards and has extensive experience advising Indian corporates and government undertakings before tax authorities and appellate forums, and is a regular speaker in ICAI, the National Academy of Direct Taxes, and IIM Bangalore. He also serves as the Vice President of the Bengaluru ITAT Bar Association. Sachin, thank you for joining us. We're delighted to have you with us.
Thank you, Amrita, for your kind introduction.
We can't hear you.
Before we begin the discussion, I would now like to invite Mr. Gerald Manoharan, Chairman IACC Karnataka Chapter and Senior Partner at J. Sagar Associates. Gerald, often known as Jerry, is a senior corporate commercial lawyer with over 25 years of experience advising Indian and international clients on investments, restructuring, M&A, corporate compliance, real estate transactions, and many more. His expertise includes entity setup and structuring, contracting, labor compliance, and employment matters. His expertise include entity setup. As a transactional lawyer, he has advised promoters and investors on strategic investments and ownership models, including earnouts, staggered transfers, overseas holding structures, and equity incentive plans. Based in Bengaluru, Jerry serves as the chairman of Indo-American Chamber of Commerce Karnataka Chapter and sits on the boards of several non-profit organizations. Jerry, over to you.
Thank you, Amrita. And just a couple of introductory thoughts. As a corporate commercial lawyer, we realized that it is almost impossible for us to successfully, close a transaction in a tax-efficient manner without the collaboration and the advisory of our tax consultants. And I'm quite eager to hear from both Sachin and Raghavendra on some of their experiences, on how they have managed some transactions for their clients. Because very often when we are in the final stages of a cross-border transaction, we are often faced with many surprises to say, hey, you know what, did you guys think about this? Is this going to fly from the tax authorities of the different jurisdictions? Is there a declaration that needs to be made? Is there a new disclosure that needs to be made? Should this become a CP to the contract itself or to the closing of the contract? So these nuances are something which are so essential, especially not only in a cross-border deal, but also in our domestic transactions, which we do on a day-to-day basis. I'm very sure that some of their experiences and learnings will help us get smarter And during my briefing discussion with Raghavendra last evening, I specifically told him, please do share some examples with us. Maybe some of this information is already in the public domain. Some, confidentiality clause issues may arise, but to the extent possible, please do share live transactional historical experiences that you've had. So we will take back a bag full of learnings at the end of this session. My best wishes to all of you, and I hope the audience who are listening to this webinar can also reach out and get some of your colleagues to join us. We have a fairly decent number of participants, but more the merrier, because the more we are able to share knowledge through this platform, it's a larger achievement for us as IACC. So please do reach out to your colleagues, and those who have not joined in, call upon them to kindly join the webinar as soon as possible. With those few words, over to you, Sachin and Raghavendra.
Thank you, Jerry.
Thank you, Jerry.
Thank you.
Thank you, Jerry, for setting the context so thoughtfully. With that context in place, let us now move into today's discussion and begin unpacking the practical realities. So, the person who's going to take this discussion ahead is Mr. Raghavendra Gupta. It is my pleasure to introduce him. Mr. Gupta is a chartered accountant and cost accountant with over 20 years of experience across Indian and multinational organizations. He specializes in India-US cross-border taxation, virtual CFO services, finance transformation, and strategic advisory. Over his career, he has worked with organizations such as Wipro, Tata Tea, Seat Tires, Motorola, 3Com India, Mascon Global, and Indus Towers, where he led large-scale finance, ERP, and operational control initiatives. Raghavendra, also known as RG, strongly believes that international tax and finance are strategic enablers, not merely compliance function.
Amrita, you are on mute, Amrita.
So, Raghav, we would like to understand from you what you think is this cross-border taxation is, and what your view is, and what our viewers today should be expecting from this particular webinar.
Okay, thanks, Amrita and Jerry for a wonderful introduction, definitely. And good morning, good evening to all the participants from US, India. So as Amrita said, my name is Raghavendra Gupta, and most people call me as RG. First of all, wishing you all the people very happy New Year. We all know that this year is going to be phenomenal. And thank IACC for organizing this webinar and bringing together such a distinguished group. And we all know today's topic, but I would like to keep this session more as a discussion, conversation way rather than presentation. So don't worry about too much about PPT. Of course, we can share that later. Now let us focus on the conversation, and of course, we'll open up F&A, question and answers at the end. So with that, let me start with something most of us we can relate to. So what happened in 1991? So 1991, India opened up doors to world. Okay. And it was not just an economic reform. It was a quite invitation. Okay. And at that time, one country responded faster than anyone else. Guess who? It's USA. Okay. Why? Because the US had what India needed most. One is capital, of course, global markets, large multinational entrepreneurs ready to expand. Okay. And India had what the world was beginning to recognize. A talent, of course, we know how the talent talent people are here. Engineers, problem solvers. Another important thing is cost efficient and highly quality skills. So it was a perfect match for India and US. So American companies were looking to scale faster and smarter. Indian professionals were ready to build, code, design, and deliver. Okay, so that's how the India-US business relationship truly began to flourish. The first come as an outsourcing model, we all know that. Then captive centers, then the global delivery models. So over the time, this partnership moved up the value chain from cost saving to value creation. Okay, so most successful India-US service companies began in a similar way. in the earlier days, roles are very clear. Structures are simple and the model works well. So decisions were very quick. Someone picks up the phone, sends an email, signs a contract, opens a bank account, meets the client, and job gets done. No one overthinking it because growth feels exciting and momentum matters, right? So, but as the business grows, the story begins to change. What happened? So India teams start shaping the pricing, solution, and strategy, and leaders spend more time in India. Decisions happen on calls rather than in the boardroom, and clients start seeing one company instead of two companies. Okay, that's when the complexity quietly appears. Okay, not because of something went wrong, but simply because the business is evolved. So with that context, so let us begin today's discussion on international taxation, planning, and core issues and strategies. With that, we all know that. Okay. So then, as I told you in the beginning, we will keep in the conversation mode instead of, presenting the slides. So I'll ask anyone who has, questions to ask so that it will be questions and answer mode, which will help all of us to understand better.
Okay, so RG, just to understand, as we are talking about cross-border tax, right? And as I can see in your slide, it says that matters now. Okay, so why, first of all, a very general question, because not all our viewers will be expert in tax. So why is it so much of an importance matter now? And also, what is the strategic capability and not just compliance basis for these cross-border tax?
Okay, so good. So what I can answer this question is cross-border tax challenges do not arise because companies make mistakes. Okay, this arise because companies grow. As I told you, if you see in the initial storyline, the value chain is going up. So as a business expand across borders, teams move closer to the customers, and the decisions get shared across the locations, and value creation becomes more distributed. Okay, over the time, this natural triggers questions around the permanent establishment, so transfer pricing alignment and business substance. These issues are not sudden. Okay, then they build quietly as a business evolves, especially when the tax strategy does not evolve at the same pace as the business. That's why the cross-border taxation becomes very, very important.
Okay. So, you're saying that they are becoming important, and also why does the challenges arise as the companies are growing ahead?
So why? Because cross-border tax does not just decide what you pay. Okay, it influences how you grow also. See, it impacts margins, valuations, investor confidence, and even how regulators view your business. That is very important. When tax is aligned with a business strategy, it quietly supports the value creation and scalability. But when it is treated as only the compliance exercise, what happens? It often shows up later as a lost value, surprises, and constraints on growth. So these are all the challenges. In short, good tax strategy enables the business. Poor tax planning ends up managing the damages.
So you said that lost value. What exactly, how does it show up as a lost value? I mean, just if you can just explain in just a couple of lines.
So last value is when anything happens, if you're not taking the cross-border taxation properly, that one of the dangerous thing is permanent establishment. What happens? Permanent establishment, when authorities assist, okay, you have a permanent establishment, then you become no taxing both the companies wants to tax your income. So that is how the values, it becomes more pressure and more, cash. Not only the taxation matters, but also it impacts your business growth. If you don't take care of the strategy.
Okay. So, which leads to my next question. given these risks, what should India, US, or US India companies actively manage to stay tax efficient and compliant as they are scaling?
So good question. So companies need holistic international tax strategy first. Okay. So built around six interconnected pillars. What are the pillars? Clear residence and control positioning. Of course, each one of the topic you will deal in detail going further. I'm just putting the bullet points as a all six pillars. So one is clear residence and control positioning, efficient entity and IP structuring, managing PE and business substance exposure, defensible transfer pricing aligned with the value creation, tax efficient profit repatriation mechanisms, structured talent mobility across the tax system. These are all the six pillars, which of course we are going to cover in detailed manner, so that once you take care of this, when these pillars are aligned, now cross-border tax moves from a reactive compliance issue to strategic enabler for a growth of the business. Hope I got your answer.
Yes.
Okay, now what I'll do, I'll go to the each pillar. Now I told you all the six pillars. Then people may be
Yes.
asking, what are those six pillars? So
Of
now
course,
we will go
yes.
into the detail. Now we'll go
Yes.
into the detail. So first one is residence and control. Okay, so what is that residence and control means? So many global companies think tax residence is straightforward. Incorporation in one country and comply. That's what they think. Okay. But as a business grow, as I told you earlier also, decisions, leadership, and operations spread across the borders. It goes well till somebody asks a question, where is the company really resident? Okay. Now, this changes everything. Now, when two countries claim the residence and income, dual taxation begins. Dual taxation is not easy. It stresses on your cash flow, it stresses on business, then nothing intentional. Actually, nobody has done this intentionally. Just growing business, crossing invisible tax lines. That's where we need to take care. So this is the first pillar. Okay. Now, what I want is, of course, as I told you earlier, we'll put in a discussion mode. So this is what the residence and control, the beginning of the topic. Now we'll move into the question and answers for particular on this topic. So
Yeah.
any one of you,
Yeah,
have
Arji.
questions, you can.
Yeah, is it audible, Arji?
Yes, Sachin.
Yeah. You mentioned about the PE exposure risk. And, when we advise clients, if you look at the structure, on paper, it is a very clean structure where they do something, marketing activity in US and actual functions happen here, delivery function happen here in India. It's a very clear structure when it happens. But what is that risk that you are talking about in this? Though it appears to me as a very clear cut on the paper.
Okay. See what happens, P structures, the US looks at the company's legal identity. Okay. If it is incorporated in the US, it is treated as US resident, right? And but India looks at the company's control reliability. Where is actually, it asks where key decisions are made, where leadership operates, and where the business is efficiently managed. So these are all comes into the picture. Even though in the paper it says, okay, it is incorporated in the US, I will pay the US tax and comply with the US regulations. But whereas Indian authorities looks at, so when legal identity and control reality point the different countries. One is, okay, legal is US, but control is all happening in India. Okay, so then both claim residence.
But it's the same one company, no, RJ. It's a one company.
Yeah.
One company. Then how come two countries have two standards for identifying its residence status?
See, residence status is not only the incorporation. That's what I'm saying. Residence is not merely determined by the incorporation. It also depends upon where actual work is happening. Like if I ask some of the things like shadow management, what is the shadow management? Okay. See, shadow management arises when decision makers typically like founders, CEO, CFOs are physically based in India. Okay. But run the business of US incorporated company. Company is incorporated in US, but all the activities are happening in India. And even if board meetings are documented in the US as per the, for legality, okay, if pricing, client strategy, resource allocation, and approvals happen from India, tax authorities view the effective control as being exercised there where the operations are happening. And from India perspective, documentation matters less where it is incorporated or but where decisions actually happen. That is why even though same entity, even though sometimes it doesn't have any office also, but if these activities taken care in India, then the PE comes into picture. That's where the residence
Yeah.
conflict happens.
Yeah, can you please explain how authorities view this? Of course, you gave it from a business perspective, but the
Okay.
income tax authorities or revenue authorities in US, how they view this? If you can just throw some light on that, would be nice.
Okay. So what happens, income tax authorities, it doesn't matter. That's what I told you earlier also. Income tax authorities, both in India and US, even vice versa can also happen. In India can incorporate most of the actions can taken in US. So when India looks at the business model, okay, whether it is incorporated, that is one, okay, resident status comes in the US. But that's how where is the actual operations are happening, who are the decision makers, who are the signing the deals. Deals can be signed at the US, but who are negotiating the price, who are the decision makers? The India looks into these aspects, real activities of the business. When they see the real activities of the business and see that the entire control is happening from India, then they look at it. It's a poem that comes into picture. Then they
Okay.
will say you have to pay the tax in India also.
Okay, right. So it's a nice this thing. There is a possibility of a PE exposure. Also, there is a possibility of a poem exposure, is what you are mentioning.
Yes.
See, I understand. See, I have started a business as it happens. It's a husband and wife having a company there in US, and in-laws or parents having a company in India is typically the structure that what we look at in IT ITS sector specifically.
Correct.
So let us assume they get into a problem of this permanent establishment. Now, what are the ways out they can resolve? They can come out of it if they have
So
really
based
got
out, I
into this
think
problem.
that is in the next topic is there. Of course, if you ask the
Okay,
question, that's why you
okay.
can. When we are talking completely on the poem related, how it is happens, how that can be avoided. All those things are in the coming topic. It
Okay,
is
yeah.
there. That's
Then
a
it's okay.
pillar two. You're asking the question now, so maybe it is better. I can explain the pillar two, then come back to the
Okay,
question.
okay, right, right,
Keep it this
right.
as a you can park it.
Okay.
Yeah. So anything else?
So I have a question here, and either Raghavendra or Sachin can answer this. See, what we are seeing, right, from an Indo-American perspective, and especially when we are discussing with the trade councils or the commercial offices of the US consulates, they are very keen to have Indian entrepreneurs to also look at setting up a place of business in the US, because that seems to give them a lot of leverage there locally. But unfortunately, they are early stage companies, and most of them are in the MSME category. There, I think they are all obviously going to have issues with this whole shadow management or OM concept, because it's unlikely that they will move to the US to stay there. Some of them do, but then many of them will not be in a position to do that. So how do you advise these kind of entrepreneurs?
Yeah, Gerald, yeah, that's a very interesting question. And we are, in fact, uh, uh, you know, most of our clients who come and who have got into a problem are on these lines of shadow management. And there are, in fact, very interestingly, one is the shadow management. I don't know whether RJ is going to cover that, which I saw in one of the slides, that moonlighting. From employer perspective, it is a shadow management, and from employee perspective, a moonlighting kind of an arrangement. Of course, in a shadow management, Gerald, uh, you know, while as we discussed that, the activities become so intertwined between India and US operations that if it is left unattended, the risk of this PE or poem is huge. And therefore, the consequences thereafter is going to be significant. So, what we have been advising them is to have whatever the model they have is it is something like this. Philosophically, if I have to tell you, what you say is what you do is simple solution for this. If you say that it is a US is a marketing company and India is a delivery model, so restrict and do exactly same thing and have a contract between India and US for the same thing. As long as what you say is what you do, there is no poem or this risk. Even if it is there, with arm's length pricing, you should be able to get over this particular risk. The problem comes only when it is intermingled. So, as long as it is not intermingled, as long as the documentation is supporting what we say is what we do, I think there should not be any problem. What happens is, over a period of time, when they come for our audits and all those things, we try to align them wherever they have tried to sway away from this philosophy. We advise them, and they realign and come back, and it continues. So
So just to add, Sachin, to your thing, what we call it as, moving from risk to control, right? That is what we see is clearly, as you rightly said, clearly establish and document control in the chosen country, whatever country you choose. Eliminate shadow management from India or US, vice versa, okay? And use treaty tiebreakers provisions effectively. That is one of the things. So the last thing is align operational substance with the legal structure. That's what you said. What you say, do that. These, if we take care of these are the four things, I think, Jerry, we can avoid those conflict residents.
No, so you have mentioned, sorry, I have one follow-on question so that you can just granularly break this down. You have mentioned about documentation protocol coupled with legal documentation, right? Because I don't want our documentation then to become like the tusks of an elephant, right? Because there is something to show and something which is actually used in true purpose. So can you distinguish how that plays out?
see,
No, documentation. Okay, Sachin, you can.
go ahead,
Yeah.
go ahead,
No,
Arjun,
sure.
go ahead.
Go ahead. You can go ahead.
No, in fact, um, let us assume if it is a delivery model, Jerry, and so therefore India and US, simple. This thing is you develop a product here and sell it to US at a cost plus basis. So if this is the documentation, this is actually what you do, and you create a documentation only for this. And then US, as far as strategic decisions, sales, and all those things, US enters into a contract with its employees, and there is nothing called somebody from in India, talking to those sales guys, or somebody sitting in here in India, concluding the contracts there in US. So if this is what the legal document, what it says, if you can structure the legal documentation this way, and the actions also can follow the legal documentation, that is what I think we should be able to get. We should be able to plan these risks well.
Okay.
Okay.
I have a couple of other questions, but I'm going to hold on to them.
Yeah, I think
we can
that's
discuss it
better so
later.
that flow can move so
Yeah.
that
Yeah.
can be. Okay. Thanks, Jerry. So next
So,
pillar.
yes, RJ, if you can take us through these pillars, as we've already reached the fourth pillar.
Yeah, that's what. First is over, residence and control. Now I'll go into the next pillar, which
Yeah.
is P and business substance.
So if
Okay,
you
that
can
is-
take us through all the six pillars, and then maybe, in the meantime, I'm sure even our viewers will
It will
have
be too much to digest once if I go all the six pillars once. So I think one by one, it is better to people can
Sure,
understand.
sure.
Otherwise,
Yeah.
you, me, I can understand, but the people other side should understand, right? So I
Sure,
think
sure,
one by one, it is better to do that. Maybe questions we
sure.
can keep it in so that once everything is covered, we can ask any question so that we can go back to that. Okay.
Absolutely.
Yeah.
Sure.
So PE business and most of no, to give just background, most of US, India IT companies start with a simple belief. What is the belief? No office, no entity, no tax risk. That's what the belief. If I have an office in US, I don't need to pay any tax in India. That's what the belief starts with that. So for a while, it feels true also because why should they pay tax? The company registered in the US, what is the reason to pay the tax in India? But what happens after some time, teams travels from India to US and leaders meet clients, engineers support sales. Nothing unusual. These are all happening. Every company, it happens that. But tax authorities don't look at the offices. Actually, what they look into it is, that's what in the initial talk also I told, they look at the people and behavior. Who influences the deals, negotiates pricing, makes commitments, quality, substance, then slowly is the substance building in India. Okay. So, and years later, as Sachin said, when some audit happens, the permanent establishment already existed. Now, what happens with that? By then, the risk is not theoretical. It's not a theoretical risk. It becomes a retroactive, costly, and margin eroding. This is what the PE, once somebody asserts the PE, it is not assert on the day. It happens after some years. So that is how the PE and no substance. This is a topic what I wanted to cover. So now on this topic, I suggest no, can you ask a few questions? Then I'm happy to answer so that each topic by topic it will be better to go with that. Audience can understand.
So what would you think would be the most effective controls companies can actually implement to prevent these PE exposures?
So to prevent PE exposures, what we need to do, I'll just preventing PE through structure. Okay, what we need to see is PE risk starts with the everyday decisions. Okay, and who talks to the clients, who signs deals, who negotiating the pricing. The strongest control is clarity. When you have a clarity, that is the good control what you have. The US entity owns clients and contracts. Okay, India delivers strictly under service agreements with clear authority limits, protocols, and documentation. When you do this, we can avoid the PE exposure. So when everyone knows the boundaries and follows them, PE exposure can be prevented before it starts.
Okay. So I think when you were changing the slides, I saw that there was something that just mentioned what goes wrong. So what goes wrong?
Okay. So what goes wrong, I think already we discussed, but now company suddenly has two homes without anything. Okay. And authorities at the table, both the authorities will sit and come into your office and sit on the table. Both claim the same profits. Okay. And both want their share. Now, what happens because of this? Options are very tough. Company can fight. At what cost? High advisory cost or accept a profit. Only two options are available to company. Either way, margin shrink, compliances burdens grow, and disputes drag on. The PE turns a technical issue. Earlier, it is okay. PE is a technical issue, but it turns into the business headache. If you don't take care of, this is what goes wrong if you don't take care of the PE related issues.
So I have one question here, okay? And it's a scenario, okay? I'll give you an example. I don't know whether it falls in this pillar or the next pillar. Let us assume that there is a software product company which is based in the US, okay? And they have an Indian subsidiary here. The Indian subsidiary meets the client, manages the client relationship, and convinces the client to buy the software. Okay. But the software license agreement and the software is provided directly by the US company to the Indian purchaser. How is this looked at from a tax point of view?
So this, Jerry, if you look at, I mean, this is exactly the problem that most of them they face here in India. So actually, as we discussed, the philosophy behind these things is the US company should have, done this marketing function. India company should have done only a delivery function. In the case what you suggested, Indian company is doing a marketing function as well. So there is a possibility when marketing decisions are taken here in India, the Indian authorities may say the poem of US company rests in India. Because in US you are not doing anything. The US activity, which the company which is supposed to do marketing activity, you are doing it from India. So therefore, US profits are also subject to tax in India. So this could be the risk that what we are looking at.
But then this is happening on a daily basis as we
Absolutely,
speak,
you are
right?
right, Jerry. That's exactly where we are. We face a client coming to us. As RG was saying, it is a risk that gets created because they keep doing. Initially, it starts with a simple transactions. It grows. At some point in time, they would have created a PE. They don't. They are not. They are blissfully unaware of that they have created a PE. All of a sudden, there is one audit or one scrutiny notice that has come, and the authorities recognize that, oh, this they have created.
So what happens, Jerry, just adding Sachin's thing, everyday actions when shape commercial outcomes. Okay. So what happens when decisions, commitments, and negotiations happen on the ground, authorities conclude that business being carried there, which is where it is decisions are happening. That is where they create no PE exposure without anyone intending to do it, but daily actions when it shapes into the commercial things and making the decisions. That's where the PE exposure it comes.
Understood.
Okay.
Okay, so in practical terms, how do people and the day-to-day operations unintentionally create these PE exposure?
That's what when we talked about the controls. If you see how to avoid this PE exposure, that's what first question you asking. Preventing PE through structure.
The frame, yeah.
Exactly. That's what we need to see. Strongest control is the clarity. That's what I told you. Clarity should be there. The US entity owns clients and contracts, and India delivers strictly under service agreements with clear authority limits, protocols, and documentation. So when everyone knows their boundaries, I think we can defense and a better way to not to expose to the PE. The only problem is what happens. This PE not happens when I do this tomorrow. It will happen. It will happen after 1 year when audit comes in, when investigation happens. That's where the issue.
So I think we can move to the next pillar.
Sure.
Because Jerry's question more or less covered a lot in that.
So next pillar is the important thing is value creation and transfer pricing. This is one of the basic thing, what happens, many India US companies show strong US revenues and contracts signed, invoices raised, profits on paper. That is where in the US. But the real work happens in India. Engineers build products, solutions are designed, client issues are resolved from India. For years, this model works. US sells and India delivers. This is what earlier it was, as I told you, it was simple structure. Then when the growth triggers in the organization, if India, see what happens, the growth triggers, question from tax authorities, what happens? If India creates the value, why is most of the profit elsewhere? That is where the question comes in. Now, that is where transfer pricing matters. It is about telling credible story of who creates value, who bears the risk, and who earns the profit. These three things will be addressed in the transfer pricing. So since we are kept in the discussion mode, so this is the topic, the background, and we can ask any questions.
In fact, Arji, in this US front office, that's what exactly you mentioned, right? US front and India back office operation. what is the most significant transfer pricing issue that companies face?
The basic issue, okay.
The basic, I mean, transfer pricing questions that companies must address,
See,
basically.
the core question is how much should US entity pay to Indian entity for the services delivered? Okay. This one decision determines where the profits are taxed, whether adjustments arise, and how sustainable the company's tax position is across the both jurisdiction. So this question, if you address and makes documentation accordingly, I think we can address the transfer pricing issue.
Yeah, okay. So while you changed the slides, you had I saw some 5 methods that you mentioned there.
Okay.
Which is the most appropriate method for India, US front office and India back office operations?
So most, I believe, I'll in my opinion, it is the transaction net margin method. So TNMM. Why it is? So this looks at the net margin of the tested party relative to an appropriate basis. Okay, cost, sales, and assets, and also compares it with independent companies. And widely used in the US IT services, especially when the exact comparables are not available. Okay, then why this is important, why this method is good is it works even when the exact comparables are not available. Let profits be benchmarked broadly and uses the flexible indicators that both Indian and US authorities accept the routine services. So in short, it balances compliance, defensibility, and practical reliability. That is where this TNMM looks better out of the all transfer pricing methods.
Okay. And I think what do you think is the most common error in transfer pricing errors that companies do for everyone's benefit? What are the most common errors in transfer pricing the companies do?
Usually, what the common errors, the transfer pricing troubles often start small but triggers in a big consequences. So, what are the common pitfalls are underpricing high value services, okay, using inconsistent TP methods across countries, ignoring India developed intangibles today. It's not like India as 1991. No, you need to change. And relying on outdated benchmarking. You cannot outdated some benchmark which is outdated. Then operations not matching documented risk profiles. What you do, what is document says, was as you rightly said in the initially, if it not match, these are the common pitfalls one organization does. When authorities spot these gaps, the result is large adjustments, penalties, and multi-year audits. Because authorities adjust, it will not immediate, right? It will happen after some years.
Okay. Right, Ajay. I think I'm done with.
Okay. So next one, this is basic thing actually. The next pillar is entry classification mismatching. What is entry classification mismatching? So entity classification mismatch happens when the same legal entity is treated as differently for tax purposes in two countries. Okay. So example, US treats Delaware LLC as a pass-through. What do you mean by pass-through? Profits taxed in the owner's hands, not on the company hands. But the same India treats the same LLC as a foreign company. What is that? Profit taxed on the entity level. When two countries differs, what is the impact? The same income gets taxed twice. Foreign tax credits, the treaty agreement based on that, what credits you should get, that will be denied. Withholding taxes may not align. Cash repatriation becomes expensive. Then issue usually surfaces during the audits. It's everything is it'll happen. It doesn't happen once you do. Next day it'll happen. If that is the case, then correction can be easier. But it happens after 1 year, after 2 years. That is where the problem comes in. So nothing aggressive or illegal, just a structural mismatch that quietly turns into costly tax problem as the business scales. So this is the simple misclassification of the entry, okay, entity misclassification. Okay, so this is another pillar. So
So,
anyone has asked some questions on it?
RG,
Yeah.
if you can just, give an example of that, how something can become like a tax trap for India US businesses. For example, like the Delaware LLCs are widely recommended, right? So,
Correct.
how does that become a tax trap for the India US business?
So I'll explain. So Delaware, so what happens? Delaware LLC looks attractive on paper. That's what everybody goes on that. Okay.
Okay.
Flexible, simple, pass through in the US. But in India sees them differently. So India sees it treats the LLC as a corporation, taxing profit at a 25%. But US taxes members on the same profits up to 37% it goes. Now, because the taxes fall on different persons, foreign tax credits. See, usually double treaty, what it says, if the entity is same, here treated as corporate and US also treated as corporate, and whatever tax paid in India for the tax earned, when US taxes on that, whatever tax paid in India, that can be availed as a credit. Suppose I pay here out of $100, I pay $10 here, and US taxes says $100, taxes is $20. I can adjust this $10. But when the corporate entities differs, because in US it treated as a taxed in the hands of the owners, but here it is taxed on the entity, the legal entity itself becomes difference. Then the treaty, as per the treaty, if I wanted to take that credit, it is not available. Okay, so that is where Delaware LLC can easily become a hidden tax trap, and that is where this has to be taken care. And there is a treaty breaker, that is there, but you need to go through that. You can also adjust. These are the issues, but you need to identify and then precautionary measures. It can be avoided.
So, RG, I have a follow-on question. I'm just looking at the first, box in your slide, where you say that for US tax purposes, a single member is generally treated as a disregarded entity or pass-through entity, and it also implies as a consequence that its income or loss is passed through directly to the owner's personal tax return. How does that happen in this practical situation? So, because if an Indian promoter is incorporating a Delaware LLC, okay, so how does the tax impact him in a situation like this? Because he is not a tax resident in the US, maybe he's sitting here in India. Okay, how is the tax imposed in that situation? Will it be imposed on the Delaware entity to be passed over to me, or how does it work?
Sachin, you want to take this?
Okay, right, Ajay. In fact, we had a similar issue recently, and Indian entrepreneur, he creates a Delaware entity, and as RG was mentioning about, and which is where we have picked it up this particular example as well. So, uh, it is something like this. India has incorporated a company there in US, and the company there in US says, I'll not tax you on your entity level, because I'll tax you on an India level. I mean, resident shareholder level. The shareholder is sitting here in India, and they cannot tax because that shareholder is not a tax resident of US. And as far as India is concerned, India wants to tax. India will not tax that individual, because he's not earning any income, because the company is earning, LLC is earning there in US. So if you look at it, is a very typical situation of double non-taxation. So if you reverse it, same thing, if you reverse, US company having a US citizen having a company, I mean, partnership here in India, it becomes a reverse and it becomes a double taxation. So in both cases are not right as far as your recent BEPS action pillar, uh, you know, the intention behind the double taxation avoidance agreement, BEPS action points, all these things, the intention is neither to make it as a double non-taxation, nor allow double taxation to happen. So that issue is what is cropping up in this particular trap. That is what RJ is mentioning. Even if you say in a situation like this, which is mentioned here, if there is a no taxation in both the jurisdiction, that is also not a right thing to do, because G20 nations, when they have come together, they have said, they have addressed similar thing and said this cannot be allowed. These kind of tax planning cannot be, so therefore they may disregard, and India may tax and US may tax again by disregarding these entities. Again, this becomes a complex litigation issue.
So best
So-
thing to avoid, okay, go ahead.
No, please go ahead.
No, I just wanted to see that how we can avoid these, misclassifications. What are the things we need to take care is the choose entity forms treated consistently both India and the US. That's one thing we need to say. Often the corporation is good example. Both, India also corporation, there also corporation. So where possible, use check the box elections to align the classifications. That is one another thing, and evaluate branch versus subsidiary carefully, considering the credit symmetry, business duration, and regulatory needs. So when the classification align across the jurisdictions, double taxation and audit risk can be minimized. So these are the few things. If we take care, I think the misclassification, the risk of double taxation can be avoided. Yeah, you go ahead.
So what would be the key takeaway for founders? Because there can be
So-
mismatches in the classification,
Yeah,
there
key
can be
takeaway, if I tell
failures
you,
in the taxation, in the
Oh.
practice, and especially when you're looking at the different strategy classification. So
yeah.
what should the founders actually think and then strategize, or what should their goal be?
So what takeaway is, the founders should, so sometimes what happens, founders, now today information is available everywhere. You can put
Yeah.
in Google, they even some people comes in there, sir, you can do like this. He'll show the chat GPT, Google, no, what it says. So best thing is founders should connect the advisors, act as, so what advisors, why advisors? Advisors act as a early warning systems. So that is one thing I can recommend. Then they spot classification mismatches, model, tax outcomes, check treaty. Okay, that is how now even when we are discussing with many of the people in US, they have best of the best chartered accountant in India, best of the best CPA in US, but still they end up with the problem because CPA doesn't know what happens in India. Chartered accountant doesn't know what happens in US. So when you know both the things, advisors also carefully you need to select whom you wanted to select. So like that, if you do that and advisors spot mismatches, model tax outcomes, check treaty eligibility. That also they'll check, and design compliant structures under evolving BEPS rules. So when you take care of all these things, this is the best takeaway for the founders to make sure, because always, everyone should work on their strength. So sometimes our business owners they'll say, no, everything I know, I will do that, but end up in problem and then land in, situations.
So keeping the interest of time in mind, I think we still have two more pillars.
Profit repatriation, which is very, very important. Everybody looks for it.
Yes.
Many end users reach a point where the business is finally working. Okay, clients are paying, and India operates profitable. Compliance is done. Then the simple boardroom question comes up: when and how do we move the money back to US? Okay, so then that's when founders realize that making profit is only half of the journey. Okay, and moving those profits is a different challenge together. So without moving so what happens, withholding taxes reduce payouts if you don't take care of that, and tax credits don't always match and FEMA rules, filings and approvals add friction. So we go through many challenges if we don't take care of few of the things which we have, question answer session. So I can cover that so that our, yeah, anybody asks the question on profit repatriation, a few things can be answered.
So, on this profit repatriation, RG, I mean, is there anything that DTA will help in minimizing this profit repatriation risks?
Yeah,
Of course,
of
I
course.
saw these efficiencies, some of the risks that you have mentioned.
Yes, yes.
That,
So,
yeah,
go
go ahead.
ahead, Sachin, please.
No, that if there is any DTA, I mean, I'm seeing as you are putting it, I mean, I'm seeing the slide.
Yeah,
So,
yeah.
go ahead, please.
Definitely, DTA help in improving the repatriation efficiency. Some of the things I can mention, repatriation more efficient by reducing the withholding taxes. One is dividends capped up at 15% versus 20%. Okay, and royalties and technical services fees at 10%. Okay, and but these benefits are not automatic. Okay, then companies must hold the tax residence certificates, file Form 10F, and maintain proper documentation. Otherwise, the lower rates can be denied. So, in my opinion, these are of course, there are many things. These are the
No,
few things I think.
just for the sake of everyone's benefit, what are the common mistakes in repatriation? If you can just highlight so that.
Okay, common mistakes. I'll tell you what common mistakes are there. So,
Common, yeah.
what happens, repatriation takes often start with the compliance gaps, basically. Okay. Then common mistakes include, what are the include? So weak documentation for management fees or royalties. The DTA allows for royalty, but if there is a weak documentation, then it can be denied. No evidence that services were actually provided or benefited the company. So that is one another thing. Ignoring Form 15CA, 15CB requirements. Sometimes it is a simple thing, but if you don't take care, the problem arises. And founders exceeding LRS limits. Okay, global intangible low taxed income where $250,000 can be transferred. That sometimes they exceed it. So these are all the common mistakes. What happens? Even small lapses can lead a tax disallowances, penalties, and prolonged audits, turning cash repatriation into a costly headache.
Okay.
So moving on to the last topic, talent mobility. Okay. So what happens, when people move faster than structure? That's what the problem creates. Especially, after COVID, companies went global overnight. Earlier we never used to have this type of webinars. I know we used to have, but where is the Zoom? The Zoom now everything happens in Zoom. Okay, so talent worked from anywhere, productivity improved, cost dropped. Okay, it felt simple, but until someone asked, okay, where are our people actually working from? That where the question when it comes, a remote employee stays abroad longer, a leader closes deals from the another country. Suddenly tax, payroll, and compliance obligations appear without warning. Okay, and nothing intentional, just work moving faster than rules. That's what happens after COVID. So that's why talent mobility and remote workforce compliance is no longer is a HR function. It is a growing business risk. So this is what the topic. Just I'm giving a background of the topic. If someone asks the questions, we can have a discussion mode so that some things can be clarified for the audience.
So, when we were talking about shadow one, right? So that's when Sachin had mentioned something about moonlighting also.
Yeah.
So, would like to understand that, why has moonlighting becoming such a serious compliance issues, especially for US companies and with India-based teams, and also.
Yeah.
So
So
you can just even
moonlighting
give a little example of, what exactly moonlighting is so that our viewers can actually understand that also.
So moonlighting, the example is the employee working in two companies. Since it is work from home, Nobody knows whose company where is
Not two
working.
companies, more than two companies.
More than two companies. I'm just saying, yeah, yes, more than two companies. Okay, so moonlighting is more than a side hustle. It's a compliance risk now. Okay, for US companies with India-based teams actually. So
In
it
fact, in one
creates
of our thing, Amrita, in one of our thing, the question came up was they were deducting tax under 194C. And when they looked at it, in one company, the employee was in the role. In another company, employee's mother was on roll. And when they
Okay.
looked at, mother was even illiterate. She had not even
yeah.
cleared her big, graduation, and she was paid salary of a software engineer. So
Wow.
that was kind of then agitated, and that disallowance was there. These are some of
So
Right.
the
more
things that we have.
more investigations are happening on Moonlight
Yeah.
now because a lot of cases are happened in Bangalore itself, and one of the client where we are working, it's happened. What Sachin is explaining is happened in that client. So actually it creates the three major problem: confidentiality and IP, leakage, especially in when the person works on a similar domains. Dual employment violation, dual or more than dual, as Sachin said, conflicts with contracts and Indian labor laws. The Indian labor laws, if you see the offer letter, it says within this period you cannot work anywhere. That's what if you see the offer letter who was signed up employee, it is clearly declares that he cannot work anywhere. But since it is from work from home, so now it is happening more than two companies he work. And tax and PE exposure. If moonlighting act like a contractors under US control, then it becomes a PE. Now you know PE, what happens when PE asserts your double taxation, credits denial, all those things happen. Okay, the how do I fix it? Something can be taken care, to avoid these risks. Clear disclosure, NDA, IP clauses, contractor discipline, and hiring via Indian entities instead of doing from US. Instead, these are all the few things I think. I think there are many. So few things I'm what I can say. So to take care of this moonlighting issue.
So see, we all understand that yes, talent mobility is becoming it's like a hidden risk. It's like the TNC applied kind of an option thing over here, right? Like in every ad we see or in every whatever investments or anything that somebody is doing, there's always a small asterisk with a TNC, and if you miss that, it becomes a hidden risk. So talent mobility is turning out to be something like that. So you mentioned about the PE, right? So remotely working from India, how is that creating a PE risk for US companies?
Yeah, good question. No, remote from India can quietly create a permanent establishment. Risk for US companies if employees perform core revenue generating. That's always, you remember that more decisions making, closing the deal. One of the things, if employee perform core revenue generating activities under US direction, India may see it as a fixed place of business for our virtual PE. Okay. And second thing, strong controls. That's what I told you other in the initial, the location logs, VPN records, assignment letters, and authority limits are essential to prove that no taxable presence exists. If you don't have these things, then the tax authorities. Then what? Importantly, other burden is now company. The burden is to prove that P is not exist on the company, not on the tax authorities. So now I need to go and prove that no, this is not a PE exist. Then you know what happens when I need to prove. So those so many questions. So even home office can trigger PE if left unmanaged. So these are the few things may create PT for even remote working.
So basically, tax authorities see employee mobility as a high risk, right? In basically in the cross-border structures. So, so if it is a high risk, so definitely there's also tax residency conflict, like individual tax residency conflicts, right? So if
Correct.
you can just explain that a bit.
So what happens? Cross-border employees can unwillingly create a dual residency. How it is India? No, if somebody comes in India and he become a stay here more than 180 days, then he becomes a resident. Okay. Now when for substantial presence in test for US, if it is stays more than 183 days in over a period of 3 years, the without careful tracking, employees may taxed as a resident in both countries. Okay, so the India US DTA tiebreaker can help. Okay, but only if travel and documentation are precise. You need to track the travel, documentation is proper. So this, if it takes care of this, that can be avoided.
More so, India is a financial year they do, and US
Yeah,
is a calendar
exactly.
year. Therefore,
Yes.
Yeah.
that problem also is quite rampant.
Yeah.
So just those 3 months makes a lot of difference.
Yes.
Yes.
So I have a question over here. I think this is related to the pillar 2 or pillar 3. So there's a question that says that how about C Corp in Texas, and for private limited, would C Corp be a match?
You are saying mismatch of classification mismatch?
Yes, in the mismatch of classification, yes. So for private limited, would C Corp be a match? And how would that be for Texas?
Sachin, you want to answer this?
I didn't get the question. If you can just
Yeah,
what
I
is the
think
question?
we'll come back to this. We'll elaborate a little bit more on this.
Yeah.
Okay. So Sachin, let's focus on you for a bit now.
Yeah.
Let's hear from the Chief Strategic Officer, right? So why do we call international tax planning a foundation rather than compliance exercise? Because right from the beginning, RG has used the word compliance and strategic compliance and all sorts of compliance. So why are we not using that term, and we are using the term or focusing on the term as foundation?
See, the foundation, because RG was mentioning about for 6 pillars. So therefore we said, from 6 pillars to, suppose if as a foundation 4 pillars we were to look at it, and what RG mentioned, started saying, talking about that residency. If you are
Yeah.
able to get a certainty on that residency, and then if you are able to get safeguards on P, if the safeguards what Aji was mentioning, those safeguards can be put in place. And then robust TP documentation
Yeah.
to say that where the value lies, there the money, there the tax goes. And then entity classification, a consistency in that entity classification. These, I think, are the sort of, out of all the 6 what Arji mentioned, these I would consider as 4 pillars or 4 foundations. So that's how I would rather look at it.
So to add that, just to know, when get it right, tax becomes a competitive advantage. Get
Yeah.
it wrong, compliance cost can be exceed the tax itself.
Right. So, what tangible benefits, do companies see when the 4 pillars are implemented correctly? So, how do they know that it has been implemented correctly?
Yeah. See, once if you have all these 4 pillars implemented, then you have, if it is a clear tax residency, let us say, you have a very defensible position and supported by good governance structure, and that good governance structures aligns with the treaty. And uh, it's a good way of doing business. Your permanent establishment safeguards, which we were talking about, it is sort of, we have to be aware of these things. It is not that on the last day of the financial year it gets created. It gets created at somewhere during the year, and the company or the taxpayer gets to know it at the end of the year. So these safeguards, if one were to have, as a robust mechanism, and similarly, as we discussed, where the value is created, there the tax has to go. These are some of the things that are critical so far as this international tax planning is concerned.
Right.
So specifically to answer a few of the advantages, if you implement the 4 pillars, what the advantages we get is the global effective tax rates can be 10 to 15% lower. That is one thing that is what promoters are interested. and smoother profit repatriation, which you discussed, repatriation, the risk that can be avoided, ability to scale into new markets without costly restructuring, okay, and reduced audit risk, all investigations. Then what happens, all this, if it takes care, these benefits are going to come, the payoff is management focus on growth, not on the tax disputes.
Right. So I'll have one more question. So, what is the cost of ignoring any kind of tax structure, whether it is India, US, or anything? So, what would be the actual hit or the impact if it is ignored?
Peace of mind.
I think that's the
Because-
best answer.
Because entrepreneurs look at certainty. If they want to do a business, they want to look at certainty or peace of mind. I think
Right.
the greatest benefit they get is the peace of mind.
So,
Hey, if
with
we
the,
ignore, see, of course, peace of mind is the one best answer Sachin is given. No, what companies are face is effective tax rate can be more than 50% if you don't take care of these things, and retroactive PA, TP penalties go to the more than 200%.
Mhm.
And P taxation on historical profits, not on the regular profits, what they do. Okay, and audits, once audit comes in, it is not just 3 months, 4 months. It may prolong 3 to 5 years also. So beyond money, founders lose, like as rightly said, peace of mind.
At the end of the day, it is the peace of mind.
Yes.
Right. So, Sachin, with this one more question from my side, if you can also, give us your views on today's session. So,
Yeah.
and with your closing remarks. So, we understood the complications, we understood the impact, we understood the 6 pillars, which is actually very important and why they play such an important role, right? So, understanding all those things, there are a lot of, these founders and leadership teams, whether it is an MSME or a startup, okay? So, what do you think will be the single most takeaway for them?
Yeah, see, this as RG, I think he began when he started his presentation, he spoke about the liberalization that happened in India in 1991.
Sachin, sound is very low, Sachin, little bit more.
So when RG was mentioning, is it okay now, RG?
Yeah.
Yeah, when RG was mentioning about liberalization that happened in 1991 in India, so the one robust business corridor that established was India-US corridor. And
Mm.
over the years, if you look at our Indian entrepreneurs have built globally, respected companies, coming out of India, having their headquarters in US. And if you look at what started in India at that time in 90s and early 2000s, what started as sort of a cost arbitrage kind of a model has developed into a model which is very complex and very substance driven, and which they call it as now no more a outsourcing model, they call it as a GCC model. So therefore, considering all these things now, this international tax planning is no longer a back office function. It has come to the center of the center of the table. It is a core business decision that one has to take while structuring their international business operations. So from that perspective, I would rather conclude to say that this is one of the important decisions while you are planning your business anywhere other than India plus any other country that you are looking at, establishing your operations. I think this international tax planning is at the center stage now.
So, there's one question, Sachin or RG can take it. For companies, planning global scale, how do you evaluate the trade-off between the tax efficiency of a UAE holding structure and the increased scrutiny it attracts from Indian, US, and investor diligence?
Yeah, that's a very interesting question. In fact, not only UAE, for that matter, if you look at um, any of the countries where the minimum tax is less than 15%, you are bound to get this kind of attention. Not only here, it is globally. So because BEPS action plan, this pillar 2, pillar 1, pillar 2, they talk about minimum taxation of 15% for the countries to um, uh, you know countries to have minimum taxation of 15%. Those countries which do not have that 15% of tax rate, the scrutiny is going to be more, no doubt about it. So here you mentioned it as a Dubai, it is incidental. It could be any other country which has a less than 15%. So if you are, so from a entrepreneurs, from a business perspective, if you are planning your affairs because it is going to be 50 less than 15% or zero tax, I think you have to be very careful of. It is no more uh, where it is only entity driven business plan. It is you have to prove the substance out there. So therefore, if you look at something like Singapore, which is 17%, so there is more of an acceptance level. You don't have much of a litigation that is coming out of organizations that have their companies there in India, Singapore, or Singapore, any other country. So it is far more less than when you say India and other countries where the tax rates are less than 15%.
So irrespective of the country, it just happens.
Yes.
Thank you so much, RG and Sachin. I would request our chairman, Mr. Gerald, if you can share your views about today's session.
Like I mentioned at the start of our discussion, that this presentation and this topic is so very vital when we speak, especially to entrepreneurs who are looking to go to the US. We've had instances where promoters have traveled to the US and they have used their credit cards to set up, companies in Delaware and capitalize it there, and because they have probably never understood the nuances of the tax complications that they will face, once the business operations start. And I think there are a lot of intermediaries who keep selling the US entrepreneurial stories to a lot of our entrepreneurs here in India. And as a result of which, what happens is several hasty decisions are made. While I was listening to this presentation personally, I feel that something like this is very vital for Indian entrepreneurs who are looking to move to the US to set up businesses there. And I personally feel that we should probably run the session once again with a little more examples, and try and get more of our community, not only part of IACC, but also, a lot of the startup entrepreneurs who are looking to, move to the US. Because that really seems to be the flavor of what the US policy is now setting out. And I think keeping that context in mind, we should definitely try and run a larger and a wider session, which will bring a lot more, learnings for people in this community. And I think from IACC, what we will do is work towards it. We can probably schedule another repeat session of this so that we get a larger audience who can benefit from it. Thank you so much, Sachin and RJ. I think it was very informative. I was making a lot of questions, but then I said, okay, it shouldn't become like a conversation between you and me. But I think there are a lot of questions which need answers, and I think it will help in doing it once again.
Thank you.
So thank you so much. Thank you, Jerry. Thank you, Sachin. Thank you, RG, and the entire team of MCA, and
Thank you,
to be with us.
Thank you.
So we hope today's conversation equips everybody to anticipate risks and design stronger cross-border structures and scale confidently, having the peace in mind and peace of mind both. I think that is what we need. So thank you once again, everyone, and have a wonderful evening and Happy New Year, and wish you all a wonderful year ahead.
Thank you very much.
Thank you.
Thanks.
Bye-bye.
Bye.
Thank you.